A woman stands outside a small loan office staring at a glowing sign that says Fast Cash. Inside, the lights are bright, the windows are covered, the door opens and closes every few minutes. Someone walks in desperate, someone walks out relieved. For now, if you walk through wealthy neighborhoods, you almost never see these places. But in poor areas, they are everywhere. On the same streets, next to the same stores, sometimes 3 or 4 within a single block. This isn't a coincidence. This is strategy. And once you understand why these loan offices are here, you will never see money, poverty, or debt the same way again. If you plot payday loan offices on a map, a disturbing pattern appears. They don't spread evenly across cities, they don't follow population density, they don't chase foot traffic. Instead, they cluster almost perfectly inside low-income neighborhoods, poor districts, working-class areas, minority communities, places where paychecks are thin, savings are rare, and emergencies hit harder. Now, place bank branches on the same map. Suddenly, the picture becomes clear. As banks slowly abandoned these neighborhoods, loan offices rushed in. Entire financial deserts formed, places where traditional banking disappeared. No credit unions, no fair lenders, no emergency credit options, only fast cash stores and payday lenders. This created a vacuum, and where there is a vacuum, someone always steps in to profit. But this targeting goes far deeper than location. Loan companies analyze massive amounts of data before opening a single store. They study income levels, job stability, rent pressure, medical bills, utility shutoffs, and even local pay cycles. They are not searching for wealthy customers. They are searching for financial stress, because financial stress creates urgency. This created a vacuum, and where there is a vacuum, someone always steps in to profit. But this targeting goes far deeper than location. Urgency removes hesitation, and hesitation is the only thing that stops people from accepting terrible deals. These companies don't build their business around wealth. They build it around desperation, around moments when people have no time to think, no savings to fall back on, and no safety net to catch them. That's why the stores look the same everywhere. Bright signs, simple language, big promises. No complicated terms, no small print visible from outside. Everything is designed to say one thing: you are safe, we can help right now. But what happens after that door closes is where the real story begins. Inside the loan office, everything feels simple. Fill out a form, show your ID, you have a job, in minutes, money appears. No long interviews, no credit check, no judgments. Fast approval, relief. Someone in crisis feels like rescue. Rescue comes with a clock. Payday loans are due in 2 weeks. Means if you borrow $300 today, you're expected to repay it in full next paycheck. That paycheck arrives, it is still due. It is still needed. Rotation still costs money. It hasn't paused just because a loan exists. The borrower faces a brutal choice: pay the loan and fall short on essentials, take another loan to stay afloat. Choose the second. This is where the trap closes. Time the loan rolls over, fees and interest are added. Started as $300 quietly became $400, $500, $100. Interest rates don't feel real because they're broken into small charges. Calculated yearly, often exceed 400%. Not an accident. It's the business model. Companies do not expect most customers to repay quickly. Profits come from repeat. The longer someone stays trapped, the valuable they become. In fact, the majority of industry revenue comes from people who borrow again and again, times for months, times for years. Create something known as debt cycling. Borrowers are never fully escaping, simply shifting pressure forward. A paycheck becomes a temporary pause before the next emergency. What makes this even more devastating is that most borrowers understand the math. Know the deal is bad. Know the interest is brutal. A child is sick, electricity is about to be cut off, rent is overdue, disappears. Survival takes. Offices are designed for these moments. Locations sit near bus stops, grocery stores, public housing. Hours stretch late into the night. Advertising speaks directly to fear, credit, no judgment, and cash. Promise financial solutions. Promise emotional relief. For a brief moment, deliver. Once the cycle begins, escaping becomes almost impossible, because access to traditional banking, loans, emergency savings, crisis leads back to the same door. And every return makes the trap tighter. Remains, why do so many people have no better options in the first place? Understand that you have to look at what happened when traditional banks quietly left these neighborhoods behind. A year ago, neighborhoods looked very different. The bank branches, credit unions, community lenders, who families by name understood their struggles, could open accounts with small amounts and borrow at fair rates when emergencies hit. And slowly, these banks began to disappear. Overnight, dramatically. Branch by branch, street by street, banks started closing locations in low-income areas because they weren't profitable enough. Maintaining branches costs money. Security, structure, clients. Poorer communities hold smaller balances, smaller loans, generate less transaction revenue. Corporate perspective, areas simply didn't make financial sense anymore. In time, regulations tightened after financial crises. Lending standards rose, tolerance dropped, became afraid of default suits, compliance penalties. Instead of finding ways to serve struggling communities, quietly pulled back, created banking desert, hired districts where people had no access to traditional financial services, checking accounts, fair credit lines, emergency loans, empty buildings where banks once stood. Into this vacuum walked payday lenders. Need large deposits, need long-term relationships, need trust. What they needed was short-term desperation. Banks required paperwork, credit checks, proof of stability. Offices offered speed. Banks hesitated, just rushed forward, positioned themselves as the only option left. This shift fundamentally changed how money flowed through through poor communities. Banks turned to check cashing stores, a percentage of every paycheck just to access their own wages. Savings accounts, emergency funds disappeared. Fair credit, term loans became the only lifeline. Once payday lenders became embedded, the financial ecosystem rewired itself around debt, no longer circulated inside the community, drained outward into corporate accounts, equity funds, distant shareholders. Neighborhood wealth leaked away slowly, by payment, by fee, discharge by interest charge. As the area became profitable, it grew for lenders. That created a terrifying incentive. In this system, poverty is not a problem to solve, a resource extract. That is how a quiet financial machine, economic struggle, one of the most profitable industries in modern history. The payday loan industry is worth tens of billions of dollars, built on innovation, built on technology, built on a simple reality. Millions of people living one emergency away from collapse. Behind the small storefronts and glowing signs sit massive financial structures, funds, equity firms, corporations, complex investment vehicles that turn short-term suffering into long-term profit. Prices at the counter may change. Money always goes upward. These companies, borrowers, not customers. Revenue streams, missed payment, a rollover, extension fee, penalty compounds into predictable profit. And because desperation is constant and never disappears. In fact, worse the economy gets, better this business performs. Losses, school bills, inflation, rent. Crisis feeds the system. Downturn becomes a growth opportunity. Every disaster becomes a financial event. This creates a disturbing feedback loop. When people suffer, profits rise. And when profits rise, expansion follows. More storefronts, more ads, more targeting, more data analysis, more psychological optimization. The industry evolves not to reduce harm, to increase efficiency in capturing financial distress. Yet, despite the massive damage, payday lenders defend themselves as providers of essential services. They argue they are filling a gap left by banks. They are offering access, not exploitation. Without them, would have no options at all. In a narrow sense, right. That is what makes the system so dangerous. Because only option is bad becomes normal. Time stops feeling temporary, becomes permanent. It's expense, being part of survival. Please plan around it. There's budget for it. Their communities adapt to it. That is how financial inequality becomes generational. Through one big collapse, with thousands of small payments. The story is not about blaming borrowers, about understanding the system they are trapped inside. Offices exist everywhere in poor neighborhoods because that is where desperation lives. Desperation, engineered correctly, becomes one of the most reliable profit engines in the world. Real danger isn't debt, normalized debt. Entire communities grow up believing this is just how money works. It becomes harder with every generation. Awareness changes everything. You see the system, stop blaming individuals. Once you understand the trap, start demanding better options. Once the illusion breaks, reform becomes possible. Think payday loans should be banned, regulated, or replaced? What real alternatives should exist for people in financial emergencies? Your thoughts in the comments.